Tonight we'll talk about Chapter 5, balance sheet and statement of cash flows. Preview, mostly balance sheet. So overview, we're going to look at the balance sheet, usefulness, limitations, classification format, basically what we do with the income statement. Then look at the statement of cash flows, its purpose, its content and format, preparation and usefulness. And then we'll look at supplementary disclosures and techniques of disclosure. So the balance sheet is sometimes referred to as statement of financial position, reports assets, liabilities, and equity. Right, equity would be your owner's access to residual assets of the company. Provide information about resources, obligations to creditors, and equity and net resources, and then helps in predicting the amounts, timing, and uncertainty of future cash flows. So the usefulness of the balance sheet, compute rates of return. So for instance, I compute return on assets or return on equity, or I take an income. So I need the income statement to help me here, but I'll take income and divide by total assets. I'll have return on assets. Evaluate the capital structure. So is this company highly leveraged, meaning it has a lot of loans, has a lot of debt, or is it basically a company with no debt and they raise all their money through either company operations or issuing stock? The balance sheet can also help us assess risk of the organization. So particularly even looking at the amount of debt that they have, so debt to equity, and then future cash flows. So we can do some ratios. Maybe you probably did these in 211. Current ratio, so take current assets divided by current liabilities, would help us with cash flow. Quick ratio. So there we use the current ratio, take out inventory. All right, so we can do some compute some formulas that might help us in computing or dealing with our future cash flows. We look at the company's liquidity by looking at, again, some of the liquidity formulas and how much cash is available, their solvency, how able are they to pay their current debts, and their financial flexibility. Some limitations, of course, we use historical costs for most assets and liabilities. We do use some judgments, right, and estimates. So judgments perhaps for contingent liabilities, estimates for things like depreciation. You have to estimate useful life. And then many items of financial value might be omitted from the balance sheet. We talked about the value of employees, I think, in the last chapter. So your employees, a company like Microsoft, really important, but it's not something that we ever would include or we have included in the balance sheet. Elements, of course, assets, liabilities, and equity. So assets are future economic benefits controlled by our entity, this normally by us, as a result of past transactions or events. Liabilities, any future sacrifices that we might have, so loans and bonds that are outstanding. And then equity is our interest, residual interest in the assets of the entity once the liabilities have been accounted for. All right, so classification. So assets consist of current assets, and then long-term assets just be long-term investments, PP&E, property, plant, equipment, intangible assets, and then any other assets like goodwill. Then liabilities and owner's equity, current liabilities, and long-term liabilities, long-term notes payable, long-term bonds payable, and then stockholders' equity. All right, so current assets. So cash and other assets that we probably expect to convert to cash or sell, like inventories, or consume, like prepaids, either in 1 year or operating cycle. Presented in the balance sheet in the order of liquidity. All right, so cash is normally fair value. Short-term investments, generally fair value. There are some exceptions where you use cost. Receivables, the estimated account collectible. Inventory, lower cost of market. And then prepaids are normally historical cost. So balance sheet, cash, generally any money is available on demand that we can use it and spend it and buy something. Cash equivalents are something I can turn into cash within 24 hours. So short-term, highly liquid investments, like maybe stock that I can convert, trading stock, and I convert to cash very quickly. Restrictions or commitments must be disclosed. So down here we talk about it. This is note 7. They have restricted cash consists of certificates of deposit restricted as collateral for lease arrangements and debt service with interest rates ranging from 4 to 5.5%. So the owners of these instruments, the leases and the debt service instruments, wants us to partition some of our cash, restrict some of our cash, so that they would immediately get there if there was a problem. The company needed maybe to do some calls, or they could get their cash pretty quickly since the cash is restricted for them. Short-term investments, basically they're going to the debts, type of instruments or debts or debt or equity. We have held to maturity, that'll be like a bond, trading portfolios of stock, and then available for sale. Notice that valuation is fair value. Held to maturity, this might be a bond payable, would be shown at amortized cost. Classification, I'd say for a bond, normally non-current, but you could have one for less than 12 months, or part of the bond is current and part of it's non-current. Trading securities is usually current, something that we're going to sell rather quickly. Available for sale securities can be current or non-current. That might be a note receivable, as an example. So balance sheet receivables, major categories of receivables should be shown in the balance sheet. Companies should clearly identify any anticipated loss due to uncollectible. So we have a allowance for uncollectible accounts. We have bad debt expense. So that basically shows us the amount that were lost due to uncollectibles. Amount and nature of any non-trade receivables that we might have. So we might have a note receivable that we loan someone some money, but it's not really related to our business. They're not loaning money to buy stuff, inventory from us, or we're just loaning them $5,000 because we have extra cash and we can earn some interest on it. And then also we should also clearly identify any receivables that we're using as collateral, because if they're being used as collateral, they would be restricted. Balance sheet, inventory. So basis of valuation, we can lower cost or market is normally what we use. And there's some, when we get to the inventory chapter, there's some specific ways to account for that. And then cost flow assumptions, FIFO, LIFO, weighted average, specific identification, so forth, would be the cost flow assumption. So the base evaluation, what we paid for it, should be shown at lower cost or market. And then how it flows through the company should be shown as FIFO, LIFO, weighted average, etc. Prepaid expenses. So it came, a payment before the expenses recorded. I buy insurance on October 1st for 6 months. 3 months of it would need to be, recorded on December 31st. So we have prepayments for insurance, supplies, advertising, rent, taxes. All right, so summary of the current asset section: cash and other assets the company expects to can convert into cash, can sell or consume either in 1 year of the operating cycle, whichever is longer. And here are some examples: cash, short-term investments, AR, inventory, and prepaids. Long-term investments could be bonds longer than a year, common stock, long-term notes. Tangible and fixed assets are not used currently in operations. For a good example, your land that they're holding for speculation, or there's land that they're holding for investment purposes. Any special funds, sinking fund, pension fund, plan expansion fund, cash surrender value of life insurance, all those can be shown as long-term assets. And then non-consolidated subsidiaries or affiliated companies that were using the equity method or cost method to account Those would be shown as a non-current asset. All right, so here are just some examples of long-term investments that are non-current assets. Held to maturity, again, would probably be something like a bond, so that would be shown at cost. But trading securities is probably stock. Available for sale might be a long-term note receivable. We'll record those at the fair market value of that instrument. And then just here's the balance sheet presentation of long-term investments, as well as property, plant, and equipment. So it's I guess an overview of your non-current assets. Property, plant, and equipment is just tangible property, assets used in regular operations of the business. Could include physical property such as land, building, machinery, furniture, tools, and resources like minerals. With the exception of land, company either depreciates or depletes, right? Wasting resources, minerals will be depleted. These types of assets. All right, slide 19. So intangible assets normally kind of lack a physical substance or really are not considered financial instruments. They're limited life intangibles, they're amortized, they're indefinite life intangibles tested for impairment. All right, so things like goodwill, patents, trademark, franchises, copyright would be considered intangible assets. And goodwill has limited life. We would amortize the same as patents, trademark, franchises, and copyright. But we may have some, I think, related to goodwill. We have indefinite life intangibles tested for impairment. That would be an example of goodwill. Or these others, patents, trademark, franchise, and copyright, would be limited life intangibles that would be amortized over X number of years. Other assets, items vary, and it can include long-term prepaids, non-current receivables, assets in special funds, deferred income taxes, property held for sale, or restricted cash or securities. And then here's just the presentation on the balance sheet of the other assets. All right, so companies should classify their liabilities as either current or long-term. So current liabilities are those liabilities we expect to reasonably collect, liquidate, either through the use, not collect, but liquidate either through the use of current assets or the creation of other current liabilities. A long-term liability, of course, would be an obligation that we don't reasonably expect to collect in the next year. Here's the stockholders' equity section of the balance sheet, and the sections: capital stock, additional paid capital, retained earnings, given other comprehensive income, which we saw in the previous chapter, treasury stock, and non-controlling interest, minority interest that we use cost method or equity method to account for. Treasury stock, by the way, just as a trivia question, would be the only, or a good multiple choice question on the next test, would be the only, and that's seen here, would be the only stockholders' equity account shown here that would have a debit balance. Dividends also have a debit balance. All right, so here are some examples of equity accounts and their classifications. Investment in preferred stock would be a current asset or could be an investment if it's long-term. Treasury stock would be part of equity. Common stock, part of equity. Treasury stock, by the way, is when we buy our own stock back. Common stock is stock that we issue to our shareholders. Cash dividends payable would be a current liability. Normally we pay that within 30 days, I think, of declaring the dividend. Accumulated depreciation would be a contra asset, so an asset account with a credit balance. Interest payable would be a current liability. Deficit would be something shown in the stockholders' equity section. Trading securities and would be a current asset, unearned revenue, current liability. Let's go to the statement of cash flows. So income statement, statement of stockholders' equity, retained earnings statement, balance sheet. It will show some information about cash flows. Statement of cash flows gives us a more detailed summary of our cash flow situation. So the purpose of the statement of cash flows gives us good information about cash receipts and cash payments that we have during the period. We ask these questions, where did the cash come from? What was it used for? And what was the change in the cash balance? We have 3 different sections: operating, investing, and financing. So cash flow from operating activities, cash was reduced because of the purchase of inventory. Cash flow from investing activities, because cash was reduced because I invested in an investment in stock of another organization, common stock of another organization. All right, and then financing activities, those things that bring in cash to the company. Example of financing activities might be the issuance of a long-term bond. We're going to receive cash inflows from that bond, although there's going to be outflows because we have to pay back that bond. All right, so there are three types of transactions. So operating might be purchase of inventory, investing, so can make and collect loans, acquiring, disposing of investments. So purchase of property, plant, and equipment, purchase of investment in stock of another company, making loans, so issuing a note receivable, and then financing or obtaining resources from owners and providing them with a return on their investment, and then borrowing money from creditors. So issuing bonds, issuing common stock, right? That's we receive resources, cash from our shareholders, and then we provide them with a return on their investment that hopefully the stock would go up, and maybe they'll get lucky. You'll pay them a dividend. Here are just some examples of each of the operating activities. So if I have cash receipt exceeds cash expenditures, that's an inflow of cash. All right, increasing my cash flow. So if I, had more sale of inventory than purchase of inventory, so those are my 2 cash operating activities. That would be an inflow of cash. Operating activity, outflow of cash expenditures exceed cash receipts. So the choice I used earlier, right, was the purchase of inventory for cash would reduce our cash. Investing, so if I sell property, plant, and equipment, sell equity securities, collect loans, that would all increase cash. On the other hand, if I buy some property, plant, and equipment, I buy some debt and equity securities, or I buy some investments, and I make loans to other entities, a note receivable is going to reduce my cash because I'm paying some other entity, the face value of that note. And then financing activities, so an inflow might be issuance of common stock, issuance of bonds, paying back the common stock, redeeming the debt, payment of dividends. All those will be outflows of cash. So all these 6 activities relate to your cash pool, these in a positive way, these 3 in a negative way. We may have significant non-cash activities. So for instance, I might issue common stock to buy an asset. So there's no cash that changes hands, but that is a significant non-cash activity and should be shown either in a separate schedule or shown as a note to the statement of cash flows. Well, it can be shown in a note in the disclosures. And we'd have to note that this is related to our statement of cash flows. We bought a long-lived asset using common stock. So these are some examples of those non-cash activities: issuing common stock to purchase assets, converting bonds into common stock, issuing debt to purchase assets, so forth. Usefulness of statement of cash flows: without cash, company of course will not survive. Cash flow from operations. Have a high amount of cash flow from operations. Could probably generate sufficient cash to pay my bills. Low amount, that means I might have to use some of my non-current assets, or I might have to borrow or issue securities to pay current bills. A lot of companies will get a line of credit for that. Free cash flow, so amount of discretionary cash flow company has that might be used for additional investments. So this is if you're doing well, and we went ahead and recorded our cash outflows and our cash inflows. Our 411 cash outflows are 271, so we got free cash flow of 139. So it just shows you the amount. I guess this sort of thing would be part of your notes. You would disclose the amount that we have of additional cash that we have to make additional purchases in the future. And then for the balance sheet, we may have some supplemental disclosures like contingencies. So a major event, maybe we're being sued, but has an uncertain outcome. If it's uncertain and it's not probable, we're probably just going to report that in the notes to our financials. Sometimes you might have to accrue a certain portion of the contingency in your financials if it's considered something that's likely to occur. So a lawsuit, and it's very, very likely we're going to lose. Probably we're going to have to report that and show, accrue some of that to the current statement. Accounting policies, so what valuation methods we're using, what inventory methods, depreciation methods, contractual situations. So we may have talked about this earlier, right? We had restrictions on retained earnings. Hey, restrict those retained earnings by 50,000, and then you'll get the loan for 50,000. And then fair values, you disclose those, particularly if you have any fair value related to financial instruments. All right, so everything else is IFRS. I won't talk about that, but you can read through it again. I really don't cover IFRS because the GAAP accounting has been moving away from IFRS in recent years. Hey, I appreciate your attention. I'm a little under the weather, which is probably why I don't sound great. So I'm trying to get healthy. Anyways, you guys have a good week. And if you have any questions on your exam, let me know. Otherwise, I'll see you in chapter 6.